So how do you go from being a real assets guy or oil and gas and real estate to being a CIO? I mean, that is a transition that there's probably a lot of folks listening who are kind of curious about that, maybe see themselves doing it. But it's, given that real estate's usually, maybe 5 to 20% at the high end of a portfolio, like how'd you figure out the other 80+%?
I think people often view the asset classes as much more different than they are.
Okay.
Now, there's distinct lingo. There's certainly unique relationships, and all of that matters. I think it would be harder to go from running real assets to running public equity. But if you're going to the CIO chair, you're not running public equity. Mm-hmm. You're managing someone who does run public equity. Mm-hmm. And so I think first and foremost, you need to be a manager.
Right.
The CIO job is fundamentally managing your team. Right. And managing your portfolio. It is different in that, I don't even today have the time or the ability really to be in the weeds like I used to. I miss that from time to time, by the way.
Yeah.
But you're managing the team. And having done that in the context of Morgan Creek, really prepared me to do that again as CIO of Willett. You do think a lot about portfolio structure and how things work together and the macroeconomic world. I think being in commodities particularly prepares you for that, because that is a lens mm-hmm. that you're going to need to mm-hmm. view what's going on economically as well. So it's a combination of things, but primarily for those who are thinking about making that change, be sure that you want to be a manager, because that is what the CIO job is.
Did you spend much time thinking about culture as you were thinking about being a manager?
All the time. What kind of culture do you want to build has to be a deliberate decision. And otherwise, it kind of evolves and can spin out of control.
Right.
For me, it's about transparency and accountability and being very candid with people mm-hmm. so that we don't waste anyone's time internally or externally. And sometimes people didn't love the candor, but I think over time we evolved to a team that really did, and it allowed us to be incredibly efficient.
Yeah. Do you? I often think about how I've been the product of the places I've worked in terms of culture. And it's very hard to not pick up those habits even unconsciously. So talk to us. Did you find that at all? And how did you train yourself to be better at it?
Well, the truth is the hardest part of that is coming out of New York and back to North Carolina. New York famously is a little more sharp-elbowed, efficient maybe as a result. And so really thinking twice before you say exactly what's on your mind. That's been something I needed to relearn.
Oh, it's one of the, yes. I've often, though, been so impressed with the gracefulness at which people can do things like say no in Southern. Yes. I used to have a book called Do You Speak Southern? And I would have to read it before bed most nights if I was going down to, visit anywhere south of the Mason-Dixon line, because that wasn't my natural inclination. So
for those who don't speak Southern, when someone says bless your heart, that is not a compliment.
Oh, I'm going to need a refresher, Brad, but okay. So how did you think about, in the context of, say, when you were at Willett, generating alpha? Or did you even need to generate alpha?
We absolutely did. We very much believe, and I believe here at the Treasury Department too, in accountability. Mm-hmm. What are you trying to do and how are you doing? Mm-hmm. So for Willett, there were really no excuses. That was the downside, if you will, not for me, but if people thought about it that way. Working for Mike Bloomberg, you had a very clear goal. It was an aggressive goal, mm-hmm. and you were expected to meet it. Mm-hmm. And, in different categories, there are access problems. Venture capital comes to mind, where, you may look at a venture capital index and it's uninvestable. Unless you were with Sequoia 30 years ago, you can't track that index. But we set the bar very high. I expected people to meet those expectations, and by and large, they did. So, no, we were looking for alpha. You have the question of what's structural alpha and what is alpha that is embedded in the leader of that asset class by virtue of relationships, essentially. Mm-hmm. Structural alphas are always better. Right? Yeah. Can we have something that almost always guarantees us outperformance? Usually those are fee structural alphas and capital deployment cadence alphas. So can we be more exposed to better vintage years and less exposed to bad vintage years? And can we pay less in terms of net fees because we're co-investing or direct investing? Those are what I'd call structural alphas. And then can we pick better? And that is, some people do that really well. It's harder to predict, and it's harder to be consistent with that.
Do you think by asset class it makes a difference? Like vintage year is more important in, say, venture capital or real estate than it might be in private equity? Or
I would think, I hadn't thought about that question in that way, but I would think the credit-oriented asset classes are where vintage year is going to matter the most, right? Because downside is so much more than upside.
Right.
If you get the downside wrong in structured credit, in traditional credit, or in real estate, particularly core real estate, there's nothing you can do to recover.
Damn, for somebody who hasn't thought about that much, that's a great answer.
Well, Nancy, I've been at this a long time, and I've lost a lot of money. Fortunately, I've made more than I've lost, but you wear the losses pretty hard, and hopefully you learn from them.
Do you think it's more of a relative game? Performance is more of a relative game when you're in a seat like you're in today versus a seat like the Willett seat where it was more of an absolute return game?
Not here.
Okay.
North Carolina has not performed particularly well. It's one of the reasons that I was excited to take this job or to run for this job, that we really needed a reset of our investment strategy and we needed to retool our portfolio. The reason for that is in almost every case an asset allocation reason. And so it is here too. Right? We're just not taking enough risk. We're kind of a 48-52 equity to debt portfolio here in a world of 70-30s. You may have a good quarter here or there, or a good year sometimes, but you're never going to have a good 10 years on a relative basis. Yet it didn't really trouble people here because they understood it was an asset allocation problem that was from the top down and to some degree was cultural to the state because it's been going on a long, long time. So I'm trying to change that. We are focused on what others are doing and how we're doing relative to them. But I don't want to lose sight of the simple fact, and that's that we actually just need to make 6.5%.
Is that the actuarial assumption for the pension plan?
Yep, and we haven't done it in 20 years.
Wow. So, seriously?
Well, we've had 1 year periods here and there, but in aggregate we haven't.
Yeah.
And that's why the only reason we have a pension deficit here. If we had been a median pension plan, we'd be overfunded. We're not.